Welcome to Breaking News to Trading Moves. Today we're focusing on a development in the tech sector, a financial report that's giving us some real evidence about where corporate money is going.
And just as importantly, where it might be pulling back from.
Exactly.
And that development is the recent earnings report from UiPath, the automation platform company. That's ticker PATH.
Right. And what made this report so instructive, really, was the proof it gave the market. Enterprise spending on AI automation. It's not just a talking point anymore. It's happening, and it seems to be speeding up.
It's moving from, cautious trials to real large-scale deployment.
So our mission today is to analyze what this acceleration means for the whole tech ecosystem. We're going to look at the kinds of companies that are set up to benefit from this, the ones that might catch a tailwind.
And on the flip side, we'll identify the companies and even whole sectors that are likely to feel some pressure as this automation trend really takes hold in the corporate world.
It's a story of capital reallocation, and we have some fresh financial data to guide us. All right, let's start with the catalyst for all this. UiPath, PATH, reporting results that were well above what analysts had on their models.
It wasn't a small beat either. This was a clear signal of momentum.
And the stock reacted pretty strongly.
It did, because the numbers provided clarity on a pretty foundational trend. I mean, we've talked for years about the promise of robotic process automation, RPA, and now you have generative AI being layered on top. UiPath's results just confirm that we're moving out of the pilot program phase, these small localized tests.
And into what?
Full-scale enterprise deployment. The data shows companies are now making massive budget commitments.
Okay, can you elaborate on that distinction for us?
Yeah.
Because that jump from a pilot program to a full-scale deployment, that seems to be the core of it. That's the whole story.
It really is. A pilot program is typically small. You automate maybe 5, 10 specific processes inside one single department.
Like what, for example?
Think about automating invoice handling in accounts payable, or basic password resets for the IT help desk. Very contained.
And the budget for that is small, I assume.
Right. It's manageable. It often comes out of some small departmental efficiency fund, and the whole thing is treated like an experiment. The goal is just proof of concept. Does this tech actually work for us here in our environment?
Okay, so that's the pilot. If that goes well, what does the full-scale deployment look like? Why does that require so much more capital?
Because full scale is a completely different animal. You're not talking about 10 processes anymore. You're talking about standardizing and automating hundreds, maybe thousands of processes across the entire company.
So finance, HR, supply chain, everything.
Everything. This isn't just about efficiency anymore. It's about a structural transformation of how work gets done, and the spending reflects that. It moves out of the departmental operational budget and into the corporate capital expenditure budget, CapEx. So when you see revenue accelerate for a platform like UiPath, it proves that big companies are now allocating serious capital, multi-year licenses, big implementation budgets.
They're buying software robots and AI agents to run their core functions.
And that's the key structural insight. The spending is shifting from OpEx, which is often labor costs, to CapEx, which is an investment in a durable asset. In this case, that asset is software.
So they're not just experimenting with replacing labor. They are actively acquiring assets that are designed to perform labor functions at a massive scale.
Precisely. For years, corporate spending on AI kind of lagged the hype.
Right.
Because the tech, it often required too much custom work, or the return on investment just wasn't clear enough to justify the big upfront cost.
But UiPath's numbers suggest that's changed.
It confirms that the decision makers, the ones who write the checks, they've moved past those hurdles. They're signing on the dotted line because they expect an immediate, measurable return.
And when a company commits real capital like that, it validates the whole ecosystem around that technology.
It does. It shows the deployment risk is viewed as low, and the return from automation is seen as predictable and, more importantly, scalable.
When we talk about what these software robots are doing, we're talking about tasks that are, rules-based, repeatable.
Rules-based, highly repeatable, and high volume. That's the sweet spot. Think about the core transactional work in any big company.
Like
reconciling accounts between 2 different systems, extracting data from a PDF or an email, running compliance reports on a schedule, handling routine employee onboarding paperwork. These are things that eat up thousands of human hours every year.
And the spending acceleration tells us businesses are seeing the payback on this right away.
Immediate efficiency gains. Plus, you get 2047 processing and almost perfect accuracy.
And this wasn't just a one-off good quarter, right? UiPath also raised its future guidance.
They did, which signals that they have confidence this trend has legs. It's not slowing down, it's actually intensifying.
And raising guidance in enterprise software, that's a pretty definitive statement.
It is. It suggests management is seeing either the average deal size is getting bigger or their existing customers are expanding aggressively.
The classic land and expand model.
Right. A customer has a successful deployment in one department, and now they're rolling the platform out to every single department.
So wider corporate adoption is becoming the norm.
That's the takeaway. And that foundational point, that structural commitment to automation, that really sets the stage for our whole analysis of who wins and who loses from here.
Okay, so with that confirmed acceleration in automation spending as our foundation, let's talk about the companies and sectors that are set to benefit. We're looking for where that new CapEx is flowing after the initial UiPath license gets bought.
We've identified three primary categories here. These are basically the supporting infrastructure layers you need to make these big automation deployments work, to make them stable and intelligent.
So the first category is the most direct one. It's the AI automation platforms themselves. The whole group gets a boost from the UiPath report.
Absolutely. The success of UiPath, PATH, confirms this market is maturing. It's moving from being a niche IT tool to being, mission-critical enterprise infrastructure.
And it's not just about simple automation anymore, is it?
No, not at all. It's not just about what we used to call RPA, where a bot follows a preset script. It's about combining that traditional automation with modern generative AI.
Which lets the bots do what?
It allows the agents to handle unstructured data, to make more nuanced decisions, to interact with complex systems. It turns a simple bot into an intelligent digital worker.
So UiPath is the leader here. But this corporate push for standardized workflows, it probably helps others too. Who else benefits from this platform spend?
A key name that comes up here is ServiceNow, ticker NOW.
Okay.
Now, ServiceNow isn't a pure-play RPA vendor like UiPath, but they have this incredibly powerful, standardized workflow management platform.
They're huge in IT service management, for example.
Very strong there. And they're expanding more and more into HR, customer service, creator, workflows, you name it.
So how does a jump in spending on UiPath's type of automation create tailwinds for ServiceNow, NOW? Is there not a risk they're competing for the same budget, that they might cannibalize each other?
That's a crucial question. And it gets to the difference between automating a task versus orchestrating a workflow.
Okay.
Automation needs a system of record, a system of engagement. ServiceNow often provides that foundational architecture for standardizing the process in the first place.
So before you can automate a financial process with a bot,
you need a clean, traceable workflow that defines what the process is supposed to be. ServiceNow is the platform where that workflow lives. It's where employees submit requests, where processes are monitored.
So the idea is that the big corporate push toward automation, which we're seeing through UiPath, it pulls up companies like ServiceNow because you need that underlying architecture for governance.
Exactly. ServiceNow becomes the sort of operating system that the AI agents are deployed on top of and managed within.
Give us an analogy.
Okay, imagine you're building a car factory. UiPath provides the super efficient welding robots.
Got it.
ServiceNow provides the entire assembly line floor, the monitoring systems for that line, and the standardized blueprints for the process.
So the better the robots get, the more you need the assembly line to be top-notch.
Precisely. The more efficient the robots become, the faster the whole line has to run, and the more essential that underlying platform and OW becomes. The increased appetite for automation means a corresponding demand for platforms that can manage, deploy, and monitor it all end-to-end.
All right, the second category of winners. This moves us beyond the platforms and into the essential infrastructure, cloud data, and observability. Why does automating a workflow suddenly create this proportional need for sophisticated monitoring and data handling?
It's all about speed and complexity. When a person does a task, they might create, say, one transaction record.
Yeah.
When a software bot does that same task, it creates that one transaction record plus hundreds of log files, diagnostic markers, performance metrics, compliance snapshots, all of it in milliseconds.
Well, so automated workflows just generate a much, much higher volume of machine-to-machine data.
Dramatically higher. And it's all moving very quickly through cloud applications. This explosion of activity just demands robust, real-time performance monitoring.
So if I automate my global procurement system, I'm not just saving on labor, I'm also creating terabytes of new data and logs every day that need to be captured and stored somewhere.
Precisely. And what's more, the risk profile changes completely. If a human makes a mistake, the damage is usually small and contained.
Right.
If an automated system fails, let's say a bot incorrectly categorizes a purchase order or its connection to the ERP system drops, that failure can cascade instantly across hundreds of thousands of transactions.
So you need continuous oversight.
What the industry calls observability. You need it to prevent process failures and to ensure data integrity.
And what happens if that observability fails? Why not just use the traditional monitoring tools you already have?
Because traditional monitoring just looks at whether the server is running. Observability looks at whether the process is correct.
That's a big difference.
It is. If the bot that's processing millions of transactions a day starts reconciling accounts incorrectly and you don't catch it right away, you could be facing massive financial errors, compliance violations.
So this is absolutely essential infrastructure. It's almost like a hidden tax on automation success. Who are the key players positioned to capture this spending?
Well, we look at companies built to handle the storage, movement, and monitoring of all this new automation-generated data. First, you have a name like MongoDB, ticker MDB.
Okay, MongoDB, what's their role?
Their role is handling the storage and movement of this data. Automated systems work with huge volumes of unstructured or semi-structured data, things like email attachments, proprietary log files, internal data formats.
Which traditional databases struggle with.
They really do. They struggle with that scale and flexibility.
Yeah.
MongoDB's modern database architecture is very well suited for managing the sheer diversity and velocity of all this bot-generated data.
Okay, so that's the data management side. And then you have the monitoring and detection side, the tool that tells you if your 1,000-bot army is going rogue.
That is the domain of DDOG, ticker DDOG.
DDOG.
They're a key provider for monitoring performance and spotting errors in these automated workflows in real time. Datadog gives you that unified visibility. It connects the health of the physical cloud infrastructure all the way up to the performance metrics of the specific application running the bot.
So if UiPath rolls out 1,000 bots for a client,
every single one of those bots is a new data endpoint that DDOG is positioned to monitor. It scales proportionally with the complexity of the client's automation environment.
the thesis is simple then. Automation creates complexity, and observability companies sell the tools to manage it. Our third category of potential winners takes us down to the hardware layer, AI infrastructure chips. Now, on the surface, if a company is buying software licenses, why does that spending flow directly to specialized computer hardware?
This is where we have to distinguish between the old RPA and the new intelligent agent. The argument here is that scaling up AI automation, deploying these more intelligent AI agents, it just requires more data center compute capacity, specifically for running models in production.
The process known as inference.
That's the one.
So in the past, a simple bot that just follows a script, click here, copy this, paste it there, that didn't need much power.
Minimal. Standard server capacity was fine, but that has changed dramatically.
How so?
Now we're talking about intelligent agents that use large language models, LLMs, to do things like summarize a contract or classify an email or make a complex decision based on ambiguous information.
And every time it does that,
it consumes a lot of computational resources. It runs an inference cycle. And as corporate automation scales up, the demand for inference scales right along with it.
So this isn't just about the big upfront hardware spend to train an AI model. This is about the continuous ongoing power consumption just to run the model hundreds of thousands of times a day.
That is the critical distinction. Training is a big periodic expense. Inference is a continuous operational need that goes directly with the volume of automated transactions. If a company automates 500,000 invoices a day, and each one requires an AI agent to classify the vendor using an LLM.
That's 500,000 inference calls a day.
Consuming massive amounts of accelerated compute, automation is now directly tied to hardware demand.
Which leads us right to the companies that make that specialized hardware.
We have NVIDIA, ticker NVDA. They are mentioned as the primary provider of the specialized compute hardware for modern AI workloads.
The GPUs.
Their GPUs, their graphics processing units, are the standard for both training and critically for running inference at scale. If corporate budgets are moving into automation CapEx, a guaranteed piece of that budget flows downstream to buy the hardware needed to power those AI agents.
NVDA is the fundamental enabler here.
They are.
Now, companies are always looking to diversify their supply chains. Where does a company like Advanced Micro Devices, AMD, fit in?
Advanced micro devices, AMD, is another key player here. The demand for AI hardware is steep enough to support multiple major players, especially as this moves beyond just the big cloud providers and into standard corporate data centers, which is where UiPath's clients mostly operate.
So AMD provides a crucial alternative.
They do. They provide alternatives and competing performance. Their hardware is essential for powering this new wave of corporate automation. The core takeaway is the same. The success of a software platform like PATH confirms the spending is real, and that spending requires real, physical, specialized computer hardware.
All right, so this confirmed flow of capital toward automation and its infrastructure, the platforms, the data, the compute, it presents a mirror image on the rest of the corporate spending map. So we need to pivot now and look at the sectors and companies that are going to face some headwinds from this trend.
Right. This side of the analysis is all about displacement. Automation is an efficiency engine. It's designed to eliminate specific types of human tasks.
So we're analyzing who used to get paid to do those tasks.
Exactly. Or whose business model relies on those tasks remaining complex and slow. The link is very clear. The efficiency gains we just talked about have to come from a cost displacement somewhere else.
The first category facing this pressure is traditional IT services. And the core reason is that automation is targeting the repetitive, rules-based work that forms the basis of so many large managed services and consulting contracts.
And this puts corporate boards in a tough spot. They're going to start asking some hard questions. They'll question the value of paying for human labor, often on a day rate for work that a software bot can do faster, more accurately, and around the clock.
So why renew a multi-million-dollar contract for back-office processing?
When an automated agent can handle the volume for a fraction of the cost, it's a simple calculation.
So we're talking about displacing human capacity in these really well-defined, predictable tasks that were previously handled by armies of consultants.
Precisely. Think about a big systems integration project or an application management contract. Those contracts often rely on large teams of people doing routine maintenance, data reconciliation, manual system updates.
Bread and butter of that business.
It is.
Yeah.
But where you once needed human consultants to manage all that volume, now an automation platform overseen by a much smaller team can handle the bulk of it. The human role has to change from execution to governance and creative problem solving. And that just requires fewer people.
But wait, isn't there a paradox here? Big firms like Accenture and IBM, they're actively selling automation and AI consulting services. Isn't this more of a portfolio shift for them than just demand erosion?
That is a very important point, and the nuance here is key. Yes, they are absolutely still in the transformation story, but their revenue streams are massive, built up over decades on these high-volume, repeatable service contracts.
The legacy business.
The legacy business. So while they might win a new high-value contract selling automation strategy, the adoption of platforms like UiPath by their clients will necessarily eat into the demand for their low-value transactional service contracts.
So it's a race. They have to replace the low-margin service hours with high-margin advisory hours before the client just cancels the service contract altogether.
That's the race.
Which major firms are cited as being vulnerable here?
Accenture, ticker ACN, is mentioned as a major firm that could see demand shrink in those areas of rules-based back-office work. While they are a premier consultant in digital transformation, they still have this enormous service delivery business that depends on billable hours for predictable work.
And the market sees that structural tension.
It does. Between selling efficiency and maintaining revenue from inefficiency. And IBM, ticker IBM, is highlighted as another large tech services provider facing a potential contraction in that kind of work.
Especially in their legacy services divisions.
Particularly in systems integration and routine infrastructure management. The challenge for both of them is clear. They have to transition their global workforce away from managing repeatable processes and into high-value creative advisory work. The revenue from the low-hanging fruit is being automated away.
Okay, so if the big IT services firms face pressure on their long-term contracts, the staffing firms are facing pressure on just the sheer volume of placements. The second category, back-office staffing firms, targets those specific administrative roles that are prime targets for automation.
This is a direct consequence. It's immediate. Rules like invoice entry, claims processing, basic customer service, general admin duties, these are often the easiest and fastest to automate. The tasks are standardized, the inputs are predictable.
So this creates a slow, steady decline in the need for temporary workers for these jobs.
It's a subtle but steady erosion. This isn't about one big layoff event. It's about companies just not hiring. When a department automates its core transactional work, the need for temp workers just dries up.
Right. Staffing firms rely on that ebb and flow of corporate demand for extra capacity.
And if a company automates, say, 50% of its finance department's transactional work, they're not going to need to hire 10 temp workers to get through the quarterly close anymore.
So that cumulative effect shrinks the whole market for those placements over time. The software robot replaces the need for the temporary human administrator.
That's the analysis.
So which firms are most exposed to this gradual headwind?
Manpower Group, ticker MAN, is mentioned as a staffing firm likely to feel this pressure as that administrative hiring slows. Manpower Group has a huge global footprint, placing temp and contract workers in roles that are highly susceptible to automation.
So the success of a UiPath directly means less need for the human equivalent.
Especially in those high-volume admin areas. And Robert Half International, ticker RHI, is highlighted as another major firm specializing in placing administrative and back-office professionals. They face a very similar challenge.
RHI's whole model relies on that sustained corporate demand for filling those standardized admin and finance roles.
It does, and the challenge for them isn't cyclical, it's structural. Unless these firms can pivot their placement focus dramatically, toward roles that support automation, like automation governance specialist, they face a shrinking market for their traditional high-volume businesses. The rise of the intelligent agent permanently lowers the demand ceiling for temporary back-office help.
Finally, we get to a category that isn't directly competing, but faces a relative valuation problem. Slower growth AI story stocks. And the reason here is just the simple comparison effect driven by the acceleration that UiPath showed.
Exactly. The strength of UiPath's performance, its accelerating growth, its raised guidance, it sets a very high benchmark for the whole AI sector.
A new bar has been set.
It has. So when investors are paying premium valuations for high-growth tech stocks, often based on the promise of future AI adoption, they're looking for the fastest horse in the race.
Any company that's commanding that premium based on an AI story, but is projecting slower growth.
It just looks less compelling by comparison.
So this forces us to look beyond the raw numbers and look at the multiples these stocks trade at. UiPath's execution makes the difference between a promise and proven accelerating growth crystal clear.
And that leads to a reallocation of capital.
Absolutely. When the market is looking for pure confirmed growth from corporate AI adoption, a stock like UiPath acts like a gravity well. It pulls attention and capital away from companies that are growing at a slower pace.
Investors who paid a premium for the AI future in a stock are now demanding proof that that future is accelerating as fast as the market leader.
The bar for AI-driven growth has just been raised.
Let's talk specifics. Snowflake, ticker SNOW, is cited here. How does their growth profile compare unfavorably in this new context? Well, Snowflake, SNOW, is a fantastic, important data platform. But their business model is consumption-based. Their revenue depends on how much their customers use their service.
Right.
And when customers deploy automation, they might actually optimize their data processing, which could potentially slow down Snowflake's consumption growth rate. So if SNOW's projected growth isn't accelerating at the same pace we see in a core automation platform, investors paying that high multiple might start to question if the premium is justified.
Compared to the guaranteed cost displacement engine of UiPath.
It becomes a game of relative performance in the AI adoption race.
And what about a hardware provider that isn't a pure-play accelerated compute name? Hewlett-Packard Enterprise, HPE, is highlighted here.
Right. HPE is involved in selling infrastructure for AI servers, storage. But their overall enterprise growth rate is typically much lower than a pure-play software provider or a hyperscale chipmaker.
So, well, they're part of the ecosystem.
Their valuation premium, which is tied to the overall AI narrative, is now being tested against companies showing immediate, rapid acceleration from software deployment. The market is distinguishing between those providing the platform that causes the growth and those that just benefit indirectly or on a slower trajectory.
So investors are demanding that if they pay an AI premium, they need to see an AI growth rate.
And that definition of an AI growth rate just got a lot stricter. Hashtag outro.
This analysis gives us a pretty clear view of the market reallocation happening off the back of UiPath's recent performance. To synthesize what we've seen, there's a definite preference for platforms showing high accelerating growth in automation.
And for the foundational compute resources needed to power it, the specialized hardware and data infrastructure.
And this is contrasted with, well, increasing skepticism toward human-centric services, and those tech names whose growth rates, while maybe healthy, just aren't high enough to justify their AI premium in this new, faster-paced environment.
The confirmation of that massive enterprise spend on automation is the main theme. That spending is changing the corporate cost structure, moving it away from human resources doing repetitive work, which is OpEx, and toward durable software and hardware assets, which is CapEx. The market is just reacting to that structural economic change.
So let's leave you with a thought to consider, based on that displacement analysis of IT services and staffing firms. If automation platforms are now proven to replace traditional rules-based work, where is the next frontier of human value creation really located inside a modern company?
The answer to that question, the new skills, the new roles, that will define the winners of the next decade, both in the workforce and on the market. A fascinating question for every business leader and investor to think about.
Before we close, a critical reminder. This discussion is not financial advice or a recommendation to buy or sell any security. This is purely the opinion of the author of the material discussed.